Good morning, dear listeners. Welcome to Akola Group Investor Relations Conference. I'm Emilia from Nasdaq Vilnius, and I'll be moderating today's event. We will start with the presentation from the management, which will be followed by a questionnaire for the audience, and then we will have the Q&A session. Please be informed that this webinar is being recorded and will be available on the Nasdaq Baltic YouTube channel. I encourage everyone to submit questions at the Q&A section on the bottom of your screen. With that said, I am pleased to introduce today's presenter, Mažvydas Šileika, the CFO of the company. Please, the floor is yours.
Good morning, dear investor community. It's my pleasure this morning to present you Akola Group 9-month results for the financial year 24-25, which we released just yesterday, and I will take you through the newest developments in the group. So, as Emilia already presented, my name is Mažvydas Šileika. I'm the group CFO. Please bear in mind that this presentation might have forward-looking statements, but these are only company's management assumptions at a given situation in a given moment. And of course, as always, I would like to start with our group structure and what's happened or developed during the 9 months period. But basically, no major changes. We have 62 subsidiaries, as a similar amount as last time we were here when I was presenting. We are in the middle of actually cleaning or making our group structure efficient. So we are closing several companies. We are also merging several companies to make the group structure leaner, to decrease the amount of subsidiaries we are managing. However, during the last 3 months, no major changes in respect of that. If we go to our main highlights for the 9 months period, I would say that we had a really successful 9 months of this year. You could already see that during our 6 months that we are improving quarter by quarter. And in this case, we delivered 72 million euros of EBITDA versus 53 millions of EBITDA last year, meaning year on year we have a solid almost 20 million growth on the EBITDA level. Going down, you could see that our EBIT margin already reached 4%. Our strategic goal is to have 3%. So for the 9 months, we already are above the strategic goal, and our 5-year average is 2%. So basically, that illustrates how successful this quarter was for us, and how successful are the 9 months of this financial year. If you look at our return on capital employed, it is now up to 9%, almost double the amount or double the figure it was last year. And we are a few percent above our 5-year average. So that was also a good new implication in our financial statements that we generate and deliver higher returns on the capital we are employing in our business. So this EBITDA brings a nice net profit, which then translates into 25 cents earnings per share. This amount is really a big one if you compare to our 5-year average, which is 16 cents. And of course, it's much better than last year, which was around 3 cents. So the last point which I would like to make, of course, is our price to earnings ratio, which now stands below 5. And of course, it's much better than it was last year, and it's actually much better than it used to be. Or our 5-year average stands at 14.2 times. So basically, 5 is quite undervalued, at least at this point in time, if you look only at this specific ratio alone. So the management and the board is really happy with the 9-month results and our progress, which is actually really good. I would like to move to the balance sheet part. No major changes here. The balance sheet of the group actually stands close to 1 billion for the last several years, and this is the new reality of the group. because we do still have and we have quite high volumes which we trade in various commodities. But also we are quite heavily investing into factories and other plant and equipment. And now it almost stands at 245 million euros, which is a tangible increase year on year. However, our balance sheet position and liquidity stands solid. Our borrowing base ratio is 56%. It's a bit up than the last year. However, it's still quite conservative, so meaning that there's quite a lot of cash and liquidity in our system, which we use for the trading activities. We did 59 million of capex during the 9 months of this financial year. Main investments were, of course, Alytus instant noodle factory, which we finished and launched this October. We have finished after this reporting period the construction of Kėdainiai coating system plant. Iecava seed plant is almost finished as well. So those investments are going to take effect a bit in the last quarter, but more it's going to be visible next financial year. Total debt of the group is 410 million euros, and our long-term debt is around 41%. That's a 10 to 12% increase quarter by quarter, but that's connected with the investments we have done recently. Looking at our strength of the balance sheet, so capital ratio remains strong, 34%, which is close to or above our targets, and our debt ratios remain solid because our 12 months rolling debt EBITDA ratio, 12 months rolling EBITDA is 92 million. That translates to net debt EBITDA at 4.3 and adjusted debt EBITDA to 3.7 when our target is 4. So we are quite well below that, and that's still in our peak trading season. So that's really under control and managed. I would like to go then to our earnings and their dynamics. So basically, for the 9 months, we have 1.1 billion euros and a bit in sales, which is slightly above last year. In terms of volumes, we have 3% more volumes year on year and 4% more sales. So meaning that we got a bit of our growth in sales from volume-wise and a bit from price inflation. However, I would say that the growth is very modest one, but it's in line with our current market trends and as well what we are doing with our investments and businesses. So I would say that we are more or less second year in the row having sustainable earnings capacity in practically all areas of our businesses, meaning that our trading activity is more or less in line year on year. We are looking for more profitable trades. But on the food side, we are increasing our quantities as well as we have a slight price inflation, which is also growing because share of total food revenue has increased year on year, and it stands now at almost 330 million euros versus 297 million euros last year. And the share of the total food segment revenues is now 28%. But of course, we should drop down to our gross profitability, which this year is really very good. We have strong earnings capacity, which translates into strong gross profit. Gross profit for the 9 months of this financial year stands at 130 million euros, which is more by 19 million euros. So it is really a successful year for us so far. We will see how we will end it. We still have a few months to go, but this year trend is very, very good. Gross profitability is also really very high. It's 11.2% and it's higher than last year. We're really happy with that because we already, have strong profitability coming from the gross profit. The other thing which really pictures our change in group structure and earnings capacity is the share of gross profit coming from our food businesses. Now it stands at 44% versus last year, which was 36%. And this is going to close to 50-50 with our trading businesses, and we are actually quite happy because that shows how the group is diversified. That shows how different layers of earnings and businesses we actually have to bring into the overall consolidated profit and loss account. Gross profit is 11.2, and it's much higher than our 5-year average, which is 7%. But but I really would like to attribute the success of this quarter and actually all 9 months to probably two of our most profitable business segments. We have very successful year with our poultry operations. Poultry business is doing really very good. I will talk about that later on. And in terms of profitability, our milking operations or milk operations, our farming business is also showing very good results. So we are happy with that. That gives us extra profitability going forward as well. Looking at our operating profit, it stands at 47 million euros, and that's 15 million euros more than last year. Last year, we delivered 32 million, and actually that nicely translates to our net profit. If you noticed, our net profit doubled year on year. We have 31 million versus 15 million last year. So basically, all that success in operating profit was translated down the P&L. And again, the share of earnings coming from both trading and food businesses looks very good. It is well balanced, 44% coming from food and 53% coming from trading. Margin-wise, 4%, really good, above our long-term average, which is 3%, and well above our 5-year average, which stands at 2%. So basically, the reasons are the same. We had a really successful year in poultry, milking. Other businesses delivered very stable result year on year, meaning that trading is stable year on year. Kauno Grūdai and other food production is also stable. So all the growth actually is attributed more or less to two segments. Our 12 months rolling EBITDA is 92 million, as I mentioned before. So if you look on the rolling basis, we are a bit above our strategic target of 70 to 90 million euros. We will see how that goes further, and at any point in time when we see that we can reach higher than the indicated strategic target, we will, of course, communicate that to our investors through NASDAQ, informing that the management has changed the view on the target for this year. So I would like to move to our segments. We will talk firstly about partners for farmers in sense of changes in the structure of this segment. No major changes since last quarter. Last quarter, we had the big news where we acquired Elagro Trade, a company in Latvia, which we are now integrating into our trading business. Since then, there are no major structural changes. And if we look to their earnings and their capacity, we see that the sales increased only slightly in terms of euros. But there is a bigger increase in terms of volumes. We have traded a bit more, but the growth of volumes comes mainly from our input trades, and input meaning mainly fertilizers. We have a successful trade in fertilizers this year. We have actually quite regular market prices, quite regular margins, but we managed to sell more in terms of tons, and I think we have increased our market share year on year. If we look at our feed production, it's slightly lower, but that's also together with our feedstuff trade. Feedstuff trade is lower feed production. Compound feed production is actually flat year on year. And if we look at our grains and oilseeds trades, it stands more or less in the same level. 1.1 million in various commodities in tons last year and 1.1 this year. So basically, we are more or less flat. But if you remember, we were lagging a bit behind last quarters. So the first quarter was quite active in trading, meaning that we shipped and sold quite huge volumes, which we previously had in our balance sheet. If we look at the profitability, so this segment delivered 65%, 65 million, I beg your pardon, in gross profit. Similar amount of last year, slightly different contributions from different business lines. And if we go through them, we see that we have lower income coming from elevator services. That was actually visible during all the year. It was quite well calibrated in the beginning of the year. We had less quantities coming from our elevators. The grain were drier, which we took into our elevators, so that's actually decreased our earnings capacity. Machinery and services. It is lower year on year by 1 million, but we are gaining back a bit of the earnings which we lost during the first half of the year. As I mentioned before, the situation in the machinery market is quite difficult. The market of tractors have decreased in all three Baltic states year on year, at least by 15% in Lithuania, but at least by 50% in Latvia and Estonia. So that's actually quite a big hit, but you can see that we are weathering out the market slump, and we hope that with all the changes in earnings capacity of the farmers, because the coming harvest looks good, we have subsidy rounds in Lithuania and a bit of a Latvia, Estonia, that will influence the activity of the segment, and that should start picking up during the last quarter. Inputs, so we delivered 18 million gross profit from inputs versus 16 million last year. We had very successful trade in fertilizers as well as seeds, but you can see that it's a very modest and sustainable growth. We took a bit of market share, and I think we exploited well the opportunities in the market, and Linas Agro did a good job here. Feed, compound feed and feedstuff trade, more or less flat year on year, 16 million last year, 15 million this year. So compound feed is doing more or less the same margin-wise also, but we have a bit less trade of feedstuff commodities. Less trade through Ukraine due to different reasons, one of them being uncompetitive pricing, logistical issues, but that's continuing for the second year in the row. And grains and oilseeds. So grains and oilseeds delivered a higher result. We have 15 million euro versus 11 last year. And this is also connected with higher volumes traded during the last quarter. We almost reached the level of last year in terms of quantities, and those trades were actually quite profitable. So we have increased profitability of this segment, which was actually our aim and strategy going forward. So really a good year for our grain trading business as well. Let's move to food production. So this is the segment which actually is highly impacted our success of the 9 months, and really good results coming from here. In terms of sales, we delivered 32 million more of sales in terms of euros. In terms of quantities, these are very modest increases. However, if we look to profitability, poultry business is the star of the day. Really great job. And we have 44 million of gross profit coming from the segment versus 23 million coming last year. To be honest, I think the market situation is really extraordinary for now. And that's, of course, coming from both sides. One is that the demand for poultry meat is very high. We have a strong demand side. That's mainly influenced by, of course, natural increase of poultry meat consumption in Europe, but also due to various diseases which are actually present in big production markets like Poland and others that, of course, we have active regulation coming into market, which basically decreases the amount of supply of poultry meat to the market. So we are well positioned. We have efficient large operation. which we are very export-oriented, and we can exploit all the opportunities in the market because we also are well positioned with our team and structure. The input side helps as well because our feed price is stable. We had a mild winter. We didn't need to use that much of gas to heat our broiler houses. Gas price was also stable. So a lot of factors actually helped to deliver this result, which we are really proud of. And that's actually part of our growth in this quarter and this year. And we hope we see that there are some positive signs to sustain this situation for meanwhile. When we look to other segments, business lines of the segment, we see that instant and ready-to-eat food products have delivered a lower result year on year by 2 million. We have increased quantities in this part of the world. However, we have some issues and challenges while prompting up production of Alytus instant noodle factory. It wasn't yet working in full capacity, or at least at the capacity we were expecting during the 9 months. But that's actually more or less sorted out. We have a bit lower amounts of other product sales, bit tight profitability on those products. So a bit of a pressure on this business line this year. But hopefully that's now behind our backs, and we will see how it's going to be next quarter. Flour, breadcrumbs, more or less flat, a slight decrease if you can see in the gross profit. However, our new breadcrumb factory is starting their production in April. It will be still a slow testing production this year. However, that's already coming into our P&L, and that will be already visible going forward. Agricultural production. Good year for agricultural production as well, better than last year. In terms of sales, slight increase by 2 million to 39 million sales this year. In terms of tons, also a slight increase, mainly from grains. We have 180,000 tons of grains produced. 100% of them are already sold, as now we are discussing. But when we look to gross profit, we have 4.2 million of gross profit this year versus 2.9. Even though our cereals trade or grain trade was less successful this year because our input cost base was average, but you can see and notice that the commodity prices or grain prices in the market are quite depressed. They are really low, and that's actually persistent throughout all the year. So even though we had quite a good yield from our farming companies, we have managed our cost. Still, the price in the market, what we get for our main commodities, meaning wheat and rapeseed, was not enough. However, since October, November, or meaning second quarter, we have favorable raw milk prices, which are approximately 20% higher than last year. And with our efficient operation, we managed to get more profitability back home, and that translates into 5 million gross profit from milking operations versus 2 million last year. And as always, I'm just reminding that please subscribe to our news. You will get always the newest information from NASDAQ. And as Emilia informed you in the beginning, we would like to engage with you with a short questionnaire that's very important for us because we are going through our sustainability journey, and we are preparing our reports for this financial year, and we would like to engage you as very important stakeholders, investors, and I would like to ask you a few questions. I think you should see a screen already with those questions. You can press multiple answers, and please scroll down to all those questions. It's really very important that you answer and you participate. But basically, it's interesting for us. How do you integrate ESG risk into your valuation models of our company? You have three answers. Two are yes, one is no. Please choose one or several. The second question is, how would you rate the quality and completeness of our current sustainability reporting, meaning Akola Group sustainability reporting, which we are doing already for several years. Really highly appreciate it. If you are honest with us, we would like to really improve and we always have room for that. The third question is that what are your expectations for our sustainability strategy over the next 5 years? Please use multiple answers here. These are very important because we need to form our strategy going forward after this year, and your expectations as investors are really important. The fourth question is which social topics you would consider both important and requiring improvement. First is diversity in workforce, equality and opportunities, pay gap, health and safety, training to employees, engagement with surrounding communities, and I believe social topics are of secondary importance to the group. You can always choose as that as well. Please use multiple answers here as well. We have a few more, but we are basically going to the end. Fifth question is which governance topics you would consider both important and requiring improvement? Ethics, board structure and oversight, executive compensation, risk management and internal controls, transparency and reporting, stakeholder engagement, legal and regulatory compliance, cybersecurity. I really encourage you to choose at least two here because I think these are good topics and it will, bring guidance to us as well. And last question, number 6. In your models, what is the likelihood of global carbon pricing mechanisms for direct emissions coming into force within 5 to 10 years? Meaning that will you price any taxes or carbon emission fees, levies into your models, which we also could be exposed to? Hopefully you answered it. I really appreciate it. My team really appreciates that because we will use that to improve and to structure our strategy going forward. We tried this for the first time. Hopefully you bear with me. 6 questions, multiple answers. Thank you very much. I will probably stop here and we'll take your questions. Thank you very much.
Thank you for the presentation. We will keep the poll in the background, so if you still want to answer, please feel free to do that. Again, a reminder, you can submit your questions in the Q&A section at the bottom of the screen. And the first question we received is regarding your perspective for growth in the next 3 years. Could you comment a little bit on that?
For sure. We have structured our growth in the several 2 years basically in 4 or 5 major investment projects. One is acquisition of the Auga business, the soup business, as we call it. Second is increasing capacity in our instant noodle factory, doubling it. We have increased our breadcrumb capacity. So basically, these are our main investments and growth generation points going in time in our food part. In our trading part, we have invested into Alagro Trade, a trader in Latvia. So we doubled our operations in Latvia in trading. We also are building seed factory in Latvia in Iecava, which is a very successful business line of ours, both in Lithuania, Latvia, as well as in Estonia. And this will increase our capacity almost double. And in our farming companies, we are investing into biogas plant, which is being built now and will be commissioned next financial year. And of course, we are improving efficiency in our milking operations. We are a bit increasing our cow herds, and we are improving our infrastructure in 2 of our farming companies. So these are the main pillars so far, which we have communicated to investors, and this will bring growth. This will increase our EBITDA, and as I have mentioned before, as soon as we can and we are certain about and we see that we are on track to deliver the results, We will also communicate to the investor audience our strategic EBITDA target, which now stands at 70 to 90 million. Investments for sure has to move the needle upward. So as soon as we can do that, we will communicate how the group views where the strategic EBITDA target stands at.
Thank you. And another question we received in advance is, are you planning a dividend payout?
Group has its dividend policy, which stands at 20% of our consolidated net profit. We have followed this policy for the last 2 years, and unless something extraordinary happens, I don't see that the board of the group should decide differently. That's why we create these policies for investors to have guidance and expectations on the dividend capacity of the group.
Thank you. Congrats on a stellar performance in Q3. Do you see any M&A opportunities in the Baltics, especially in Lithuania?
For now on, we are not pursuing any M&A opportunities in the Baltics. We are more opportunistic at this point in time, but we are always active and open to relations and opportunities. However, at this moment, we do not have anything actually to communicate that much.
Thank you. Could you provide a little bit of an insight for recovering farmers' appetite for new equipment in view of cheaper borrowing and underinvestment? Would it be reasonable to expect a recovery in this business subsegment?
Consensus, for sure. There are several factors which are influencing the possible positive trend in this area. One is that financing cost is decreasing, meaning Euribor year on year is much lower. So the burden of interest rates is lower for the farmers to invest. Another thing is that we have quite an active subsidy round in Lithuania, meaning quite a lot of money coming into the market for farmers to invest. The third one is that the prospects of this year harvest are looking good. So meaning that farmers are more positive on their future earnings, and that also gives an incentive for them to invest. So these three factors actually are playing in, and hopefully the market will have a recovery trend.
Thank you. A question on the similar topic. Do you expect the US trade war with EU to influence the agricultural equipment market in the Baltics?
Well, I think, in our case and in some other dealer cases, there are equipment which is produced in US and shipped to European Union. So in this case, if European Union decides to retaliate with some tariffs on US goods, that could come into effect on those pieces of equipment being shipped from US. We also have machinery which is produced in US. Other dealers have as well. So that's the only case how it would be affected. But probably short term, all the dealers can manage that because we already have stock. You can get some stock in Europe. Longer term, if that persists, alternative production areas and routes should or would be then a priority for those producers to shift from US production to somewhere else to export to Europe.
Thank you. In view of the poultry segment doing so well, when do you expect things to go back to normal, or is this level the new normal?
Well, unfortunately, I don't have a crystal ball to say that if it's a new normal or when it will end. It's probably above the normal or above the average market because part of the influence is connected to diseases, bird influenza in Europe. So at some point in time, of course, that will be managed and controlled. But currently, it's quite a difficult situation, and that really influences the supply of poultry meat in Europe. So that's the factor which nobody controls, but that's probably not a factor which should persist going forward for, unforeseeable future. However, consumption of poultry meat, which is increasing year on year by 2 to 3%, is a persistent trend which we are exploring and exploiting. So that plays into our account. The other thing is that during the last 3 to 4 years, when the poultry industry was suffering heavily losses, there is a lot of underinvestment and some players have left the market. So meaning the supply is very tight. So no other reason than that why Scandi Standard is investing into capacity in Lithuania. If you follow the newest developments there with their acquisitions. And the other thing is that we have actually average or really moderate input prices, meaning stability of grain prices or wheat prices is it's actually funny, but it's not good for our farming business, but it really helps our poultry business because then we can anticipate and project stable feed prices that helps to price our products in the market. But also, I think we had made a very good quality change of our sales portfolio, where we sell and what we sell. We are very export orientated to Scandinavia, UK, Benelux. We also increase our own brand exports, and that's very good. We also have efficient operations in production. We work at full capacity, and we also have very good and efficient breeding operations, meaning that our breeding operations, the cost of our broiler meat is low. We can compete with extremely efficient Polish producers. We have scale in this area, and we can also control the diseases. It's always a risk. We are not immune to this risk for sure, but we have a majority of our breeding internally, meaning internally we do that ourselves. 20 to 30 maybe only percent comes from outside farmers, so we have a bit more control over our biological risks in our operations.
Thank you. And talking about the grain segment, how much profit do you expect in the fourth quarter? And do you expect the feed costs in the EU to rise due to higher tariffs on imports of grain from Ukraine?
No. In terms of grains and feedstuffs, we don't see big risk from tariffs for the price. I mean, there are more influences or impacts for the price coming from supply-demand differences, meaning that how will be the harvest in Europe, what will be the harvest in Ukraine and Russia. That is a major influence, but you can see that even though we have low global stock of grain and it's low for the third year, I mean, going down for the third year in a row, still the price is not picking up, meaning that there is no actual shortage of grain at any point in time, in for the producers. So even though we are producing less globally and eating into global stock, but every time and point when a grain market opens, meaning Europe, US, Russia, Australia, South America, they supply enough grain for the market. That's why the price is basically not moving that much. So, but of course, there are some risks and opportunities as well with the tariffs for agricultural production. If you follow, in terms of retaliation, Chinese put tariffs on US soy and corn as well as Canadian one. So we are not buying soy and corn or wheat from those areas. Then they are sourcing from Latin America, especially Brazil. So that means that where Brazil was exporting previously China, someone else will be exporting. That will change the trade flows, and that could also be an opportunity for us. Could be also a risk if something changes not unexpectedly. So there is not much direct influence for us from the tariffs in the agri production area, but there will be some changes in global trade flows. We are monitoring those closely, and we will see how it goes because there are also opportunities there.
Thank you. The following question is regarding the Alytus factory. Could you talk a little bit more about why production is delayed? Is it a technical or demand issue? And when do you expect it to be operating fully?
It is the demand side is more or less going according to our business plan. We have planned a gradual ramp up to 100% capacity. It was not planned instantly. Demand side is fine. As always in new factories, you have some time where you need to calibrate the production, calibrate new machinery, work out all the new things, and that took a bit more time than we planned, which happened to have pressure on profit because you have extra cost coming with that. But that's more or less behind our backs, and we are planning a smooth operation in the fourth quarter and going forward. Demand side so far is good and is according to more or less our business plan.
Thank you. And talking about the instant food segment, what is hampering profitability? And do you expect a higher profit in Q4 from instant food?
Profitability is pressured from competition. One thing, it is a competitive environment for instant products, basically in all categories. It is a growing area in terms of market size, but as well it attracts new capacities and new players. So there is competition from others, and there is, of course, a bit of a cost inflation. So those two factors are playing in there. That will be minimized a bit when we will be running at full capacity of our new factories. Then the economies of scale will take place. We will scale our cost. So that will help us to improve the profitability going forward. However, competition and input inflation will be still there. So it is hard to judge going forward, and would not like to give guidance on that. We will see how that goes.
Thank you. What is your view of harvest in the year 2025 in terms of cost of goods sold to price balance? Do you expect profitability of crops to recover? And have you contracted at least part of harvest with some more favorable prices?
Very good question. As you can see, or if you follow, if you don't, so the prices of main grains and oilseeds doesn't move that much upwards. It's more or less stable. It's not a very favorable price. It's not too bad, but it's also not something very exciting for the farmers. So if that continues and stays like this till the end of the harvest, so it won't be a lot of incentive for farmers to sell. The farmers who have their infrastructure probably will take hold on their grain and wait for better prices. But of course, part of the harvest always have to be sold. So if the price continues more or less in the same levels, the yield or the amount of the grains the farmers will get from a hectare will be crucial. More tons coming from a hectare with this lower price helps for the profitability, basically economies of scale again. So far, the harvest situation is good, even though it has decreased a bit during May, because May is extraordinary cold, and frostbite is present, especially for rapeseed. That will be some influence for the harvest. So we will see how that goes, but the backbone for the future harvest was really good. The beginning was really good. May was a bit cold, but overall, the conditions are good. In terms of our case, we have sold maybe 10% of our future harvest. You can see that's a very small amount, and the reason being that the prices, from our perspective, are not that favorable. But of course, we need to sell some to have some view on our future cash flow for the next year. But of course, everyone is quite intensely following the developments with the price to get any better spikes in the market.
Thank you. It looks like we've covered most of the questions so far. So if you would like to submit a question, please do so now. And the following question received is regarding Estonian farming market. Could you comment a little bit on it? And are the harvest prices enough for farmers to recover?
Prices for the all three Baltic markets are the same in terms of grains. So basically, all the same situation. I'm probably not going to repeat myself here. But in all the three Baltic markets, the potential for harvest looks good. The same goes for Latvia and Estonia. Probably the question is coming from that perspective that we had two bad years in Latvia and Estonia in terms of harvest quantities, because they had very bad weather conditions, frostbite, and so on. So this year it doesn't look anything similar. The conditions are regular. What really helps for the farms which are mixed farms, meaning grains as well as milk, they have a better earnings capacity due to good milk prices. So the same as in our case, we have two earning lines, meaning grains and milk. And even if the grains are a bit struggling due to low prices, our milk operations bring in quite a lot of profit. So that's success of our farming result this year. So meaning for all other farmers who are mixed farms is the same. For Estonia, especially, as Estonia has strong, large, mixed farms, they are really orientated to milk production. The good milking price really helps them as well to recover and bring in more money into the farm for now, for sure.
Thank you. And the final question is, what is your forecast for future income, EBITDA, and other financial expectations? Do you expect growth or stable?
It is a great question, which unfortunately I cannot answer. Please follow any updates from us. Rather than that, your guidance is our strategic targets, which we communicated, which we reiterate every time. For now, we see that for now the target which is communicated in terms of EBITDA is 70 to 90 million, and we have this policy that as soon as management sees potential upside from this strategic target, we will communicate that to the market if that happens. So I think it's really important for you then, if you are interested in how we develop and what's our future potential, to follow our NASDAQ announcements and see if we communicate additionally to the market regarding this part of your question. Thank you very much.
Thank you. As all questions have been answered, on behalf of Akola Group and Nasdaq Vilnius, thank you everyone. The recording of the presentation will be available on the Nasdaq Baltic YouTube channel. Thank you for an informative conference and have a great day.
Thank you very much. Thank you. Bye.